So the mood in India is festive, but some of its neighbors are not feeling it. Pakistan is sulking and showing it with a letter. Pakistan has officially condemned the consecration of the Ram Temple and urged India to ensure the safety of religious minorities. We're not making this up. This is Pakistan, which imperils everyone's safety, minority or majority. Of course, they're not happy about the event in Ayodhya. And its iron brother China is also not feeling blessed. They're losing money, and how? Investors are packing up and leaving China. Losses are mounting. The Hong Kong markets are in chaos. They witnessed a mass sell-off. It began last week, and this morning it worsened. The losses have been steep. Hong Kong stocks are trading at 36% discounts. Their value has fallen substantially. Ask an investor and they'll likely tell you, now is the time to buy. But ask an investor who's familiar with the Chinese market and they might tell you to hold your horses. This situation is like a falling knife. It's best to not try to catch it. And it's hard to say how much it will fall. But I'll give you a figure to understand how big this is. Since 2021, over $6 trillion have been wiped off from the Chinese and Hong Kong markets. $6 trillion. And Hong Kong, as you would know, is home to the Hang Seng Index. It's an important financial hub. Its value has fallen below 15,000, which is the lowest in 15 months. And this marks the end of the Hong Kong story. Before the pandemic, Hong Kong was a gateway to the mainland for investors willing to bet on China and its growth story. They used Hong Kong to funnel their investments into China, but now the circumstances are quite different. China's growth has come to a halt.
The external environment has become more complex and the severity and uncertainty have increased. Domestic demand is still insufficient. Some industries have overcapacity. Social expectations are weak. There are still many risks and hidden dangers, and there are also impediments in the domestic circulation.
Risks and hidden dangers. There's also Western pressure in the form of sanctions. They've limited China's access to advanced technologies. Plus, China is locked in a trade war with the US. Beijing was hoping for a better start to 2024, but even they admit now that it's challenging.
Looking ahead to 2024, we also need to see that the current external environment remains complex and severe. Domestic effective demand is insufficient, overcapacity in some industries, social expectations are weak, and there are many hidden risks. These are still a number of difficulties and challenges to be overcome in order to push China's economy to further rebound and improve.
So to the investors, China is starting to look less attractive. Hong Kong tried to woo them back. City officials took many initiatives. They created a task force. They cut taxes on trading, and their financial chief went on a PR tour. He visited the US and Europe and tried to drum up support, but the sentiment has not changed. Last week, Beijing dispatched the big guns. The Chinese premier went to Davos along with a 140-member-strong delegation, and there he made some tall promises.
We will also listen to the views of foreign businesses regularly. We will actively promote solutions as long as they are reasonable demands. All in all, no matter how the world's situation changes, China will adhere to the fundamental national policy of opening up to the outside world, and the door of opening up will only open wider and wider.
The door will only open wider, he says, but investors are reluctant to enter. They're pulling money out of China. We're talking about foreign investors. In 2022, they were optimistic about China. The country was opening up again. It had dumped its zero-COVID policy. So the hope was that China will soon be back in business. Investors poured some $33 billion. Turned out to be a bad bet. Instead of normalcy, they got chaos in China. Some of the biggest companies there came under fire. Beijing targeted them through policy changes and sometimes through an old-fashioned crackdown. Xi Jinping did all of this in the name of demanding accountability. What he wanted was total submission. Profits and valuations plunged, and now investors have lost patience. They're cutting their losses. By the end of 2023, they dumped about 90% of their investment. 90% of the $33 billion that they had poured in had been dumped. And the trend continues in 2024. In less than a month, some $4.6 billion of foreign cash has been pulled out. And this may not stop anytime soon. Plus, it has a trickle-down effect. China's yuan is now under pressure. It is losing value. In 2023, it dropped by almost 3% against the US dollar, and in the last 3 weeks, the yuan has lost almost 2% of its value. One US dollar is about 7.19 Chinese yuan. Beijing does not want it to fall any further, so it has mobilized its banks, state-owned banks. They've been asked to sell dollars from their reserves and exchange them for the yuan. The idea is to stabilize the Chinese currency, to counter the negative sentiment. It may help for now, but this is hardly the solution to China's problem. Financial experts in Hong Kong remain pessimistic. One agency released an assessment today, and this is what it says. We expect the yuan to remain under pressure in the near term given the bearish expectations for China's growth this year, which is unfortunate and ironic. Because in the Chinese calendar, 2024 is the year of the dragon. But given the state of their economy, the year of the bear would be more apt.